Right now, during March of 2026, the IRS permits elderly homeowners to request a real estate tax deduction that could lower their federal tax obligation by up to $11,000. However, the document needed to request it is one that under 9% of Americans above 65 actually submit. That document is Schedule A of your 1040, and the particular line that counts is the one for state and local taxes paid limited at $10,000, combined with a lesser-known adjustment that applies when you combine it with the elderly standard deduction increase that became effective in tax year 2025. If you own your residence, pay real estate taxes, and are 65 or older, you may be leaving thousands of dollars unclaimed every single year because nobody informed you that itemizing might now exceed the standard deduction for your particular situation. Here is the single most significant thing I can share with you today. The Tax Cuts and Jobs Act provisions are scheduled to expire after December 31st, 2025, which means the 2025 tax return you submit in 2026 may be your final opportunity to use the current rules before the entire landscape shifts. If Congress does not act, the standard deduction decreases back down, personal exemptions return, and the calculation changes completely. That means what you do right now, this filing season, determines whether you capture this advantage or lose it permanently. My name is James Collins. I spent 28 years inside the IRS as a senior advisor. I retired in 2021, and I have spent every year since then trying to get this information into the hands of people like you, to people who earned their homes and their retirement and should not be paying a single dollar more than the law requires. Before this is over, I'm going to show you exactly how the real estate tax deduction interacts with the elderly-specific standard deduction increase, why the calculation flipped for millions of homeowners starting with the 2025 tax year, and the precise steps you need to take before the filing deadline to make sure you are not one of the people who misses this. Let me explain how this actually works because the government does not make it easy to understand. Think of it like a grocery store that has two checkout lanes. In lane 1, you get a flat discount on your total bill no matter what you bought. That is the standard deduction. In lane 2, you get a discount based on every individual item you purchased, but you have to show your receipts for every single one. That is itemizing. For years, the standard deduction was so high that most elderly individuals were better off in lane 1. You took the flat discount and moved on. The IRS preferred this because it meant fewer people filing complicated returns, fewer audits, fewer headaches. Before I continue, if what I just told you made you nervous, that's because it should. Most retirees are losing between $2,000 and $5,000 every single year to IRS rules they never knew existed. I spent 28 years inside the system watching it happen. That's exactly why I wrote the IRS Senior Loophole Bible. 23 legal exemptions and credits the IRS publishes but never explains to retirees. And right now, everyone who gets it also receives my personal IRS deadline calendar for 2026. Every date you need to know. One page, free link in the description and first comment. Don't wait until April to find out what you missed. But here is what changed. Real estate taxes across the country have risen dramatically. The National Association of Counties reported that average real estate tax bills increased by over 19% between 2020 and 2025 in most suburban and semi-rural areas where elderly individuals own homes. Meanwhile, home loan interest rates climbed, and many elderly individuals who refinanced or took out home equity lines of credit during the past few years now have deductible interest they did not have before. At the same time, the standard deduction for elderly individuals in tax year 2025 is $16,550 if you are single and 65 or older, or $32,300 if you are married filing jointly and both spouses are 65 or older. Those numbers include the additional elderly bump of $1,950 for single filers and $1,550 per spouse for married filers. Now, here is where the calculation gets interesting. If your real estate taxes alone are $7,000 and you have $4,000 in state income taxes, you reach the $10,000 SALT cap. Add in home loan interest, medical expenses above 7.5% of your adjusted gross income, and charitable contributions, and suddenly, your itemized deductions exceed the standard deduction. For a married couple over 65, that crossover point is $32,300. For a single elderly person, it is $16,550. The millions of elderly homeowners cross that line in tax year 2025 and do not know it. The IRS does not send you a letter saying you would save more by itemizing. Your tax software might default to the standard deduction because it is simpler. And if you use a free filing service or have a volunteer preparer do your return, they may not run the comparison at all. They take the easy route. You pay the price. This is not an accident. The system is designed to be confusing. The IRS published guidance on the SALT deduction cap in publication 5307, but that document is 43 pages long and written in language that requires a tax law degree to understand. The relevant section on the interaction between the SALT cap and itemized deductions for elderly individuals over 65 is buried on page 29. I know because I helped review drafts of documents like that for years. The assumption inside the agency was always that most taxpayers would take the standard deduction and not ask questions. That assumption saves the government billions of dollars every year. It costs you real money. Right now, the political environment makes this even more urgent. The IRS workforce has been reduced significantly. If you've ever received a letter from the IRS and had no idea what to do, you need my second guide, IRS Audit Shield, the Senior's Survival Manual. It breaks down the 14 most common IRS letters elderly individuals receive, what each one actually means, and exactly what to do in the first 72 hours. Most people panic and make it worse. This guide tells you what to say, what to send, and what never to do. Grab it now at the link below, and it comes with a free bonus, my personal IRS call script, word for word, so you know exactly what to say when you contact them. The agency lost roughly 17% of its staff between early 2025 and early 2026 through a combination of efficiency-initiated restructuring, early retirement buyouts, and hiring freezes. The Taxpayer Advocate Service, which is supposed to help people like you navigate exactly these kinds of issues, has a current case backlog that stretches beyond 6 months in many districts. You cannot rely on the IRS to help you optimize your return. You have to do it yourself, or you have to know exactly what to ask a preparer to do. Now, let me show you what this looks like in real life, because numbers on a page do not mean anything until you see them in someone's kitchen. Margaret Bowen is 69 years old. She lives in a 3-bedroom ranch house in suburban Columbus, Ohio. She bought that house in 1994 for $87,000. It is now assessed at $261,000. Her real estate tax bill in 2025 was $6,840. Margaret collects Social Security of $1,840 per month. She also takes a small required minimum distribution from her late husband's IRA, about $400 a month. Her total income is roughly $26,800 a year. Margaret has used the standard deduction every year since her husband passed in 2019. Her preparer at the strip mall tax office never once ran a comparison. Here is what Margaret does not know. She paid $6,840 in real estate taxes. She paid $1,900 in Ohio state income taxes. She donated about $800 to her church. She had medical expenses totaling $4,200, of which roughly $2,100 exceeded the 7.5% AGI threshold. Add those up. That is $11,640 in potential itemized deductions. Margaret is single and 65 or older. Her standard deduction is $16,550. So, in Margaret's case, the standard deduction still wins. But here is the piece nobody told Margaret. She also paid $2,300 in home equity loan interest from a line of credit she took out in 2023 to fix her roof. That brings her itemized total to $13,940, still below the standard deduction. Margaret is fine this year. But if her real estate taxes increase by even $1,500 in 2026, which her county assessor's projected rate suggests they will, she crosses the line. And if the Tax Cuts and Jobs Act sunsets as scheduled, the calculation changes entirely because the standard deduction drops back to a much lower amount, potentially around $8,000 for a single filer plus the elderly bump. Margaret needs to know this now, not in April of 2027 when it is too late. Now, let me tell you about Carl and Diane Phelps. They are 71 and 68. They live in Bucks County, Pennsylvania. Their real estate taxes are $11,200 per year. They are already above the SALT cap. They collect combined Social Security of $3,640 per month. Carl has a small pension of $700 a month. Their combined income is about $50,400. They have taken the standard deduction for married filing jointly, which in 2025 is $32,300, including both elderly bumps. But Carl and Diane also have significant medical expenses. Diane had a hip replacement in 2025. Their unreimbursed medical costs after Medicare paid its share came to $9,400. The 7.5% AGI threshold on $50,400 is $3,780. So their deductible medical expenses are $5,620. We add the $10,000 SALT cap, the $5,620 in medical expenses, their $3,200 in home loan interest on a home equity line, and $1,400 in charitable giving. That is $20,220 itemized. That is below their standard deduction of $32,300. They should take the standard deduction. But here is the critical thing. Carl has not yet taken his required minimum distribution for 2025. If he takes a larger distribution to cover some upcoming expenses, his income goes up. More of their Social Security becomes taxable, and the entire equation shifts. Every dollar of additional income can trigger taxation of up to 85% of their Social Security benefits. Carl and Diane need to understand this interaction before they make that withdrawal, not after. The IRS will not warn them. Their bank will not warn them. The brokerage that holds the IRA will send a 1099-R after the fact. By then, the tax impact is done. And then there is Robert Suarez, 66, in Maricopa County, Arizona. Robert just retired. He started Social Security at 66 and 2 months, his full retirement age. His benefit is $2,180 per month. He owns his home outright, no home loan. His real estate taxes are $3,900. Robert assumed that since he has no home loan interest to deduct, itemizing would never make sense. He takes the standard deduction every year. But Robert also pays $1,800 a year in Arizona state income tax on his pension income. He donated his late wife's car to a veterans charity and received a fair market value deduction of $4,200. He had dental work that cost $3,800 out of pocket. Robert's itemized deductions for 2025 add up to roughly $12,100 before the medical expense threshold calculation. After applying the 7.5% floor, his medical deduction is smaller, but the total still reaches close to $11,000. His standard deduction as a single 65-plus filer is $16,550. So, Robert is better off with the standard deduction for now. But Robert does not know that his county just approved a reassessment that will raise his real estate tax bill to an estimated $5,600 in 2026. He does not know that Arizona is considering conforming to federal tax changes that could alter his state tax situation. And he absolutely does not know that if the TCJA sunsets in his calculation, changes completely. Here is the question I need you to ask yourself right now. Do you know to the dollar what your total itemized deductions would be if you added up your real estate taxes, your state income taxes, your medical expenses above the threshold, your home loan or home equity interest, and your charitable contributions? If you cannot answer that question, you are making a $16,000 decision based on a guess. That is what the standard deduction is. It is a guess that the IRS made for you, and it may be incorrect. Now let me tell you what they do not tell you. because this is where my 28 years inside the system actually matter. The IRS publishes a document called Publication 501 that explains who should itemize. But Publication 501 does not contain a simple comparison worksheet that an elderly homeowner can fill out in 10 minutes. You have to cross-reference it with Schedule A instructions, Publication 502 for medical expenses, Publication 526 for charitable contributions, and Publication 936 for home loan interest. That is 4 separate documents totaling over 160 pages. The IRS knows this is impractical. Internal memos I saw before I retired discussed creating a simplified itemization comparison tool. It was never built. Budget cuts eliminated it. Here is something else. The IRS Free File program, which is available to taxpayers with adjusted gross income below $84,000, includes software that theoretically runs the standard versus itemized comparison automatically. But the Government Accountability Office reported in 2024 that only 3% of eligible taxpayers used Free File. And of those, a significant percentage reported that the software defaulted to the standard deduction without clearly showing whether itemizing would produce a better result. The GAO report number is GAO 2416249. It is public. You can read it yourself. The system is not manipulated in the dramatic sense. Nobody is sitting in a room trying to cheat you. But the system is built for efficiency, not for your benefit. The default settings favor simplicity. Simplicity means the standard deduction. And the standard deduction is not always the right answer for an elderly person who owns a home in a state with rising real estate taxes. There is another piece that almost nobody talks about. IRS Publication 524 covers the credit for the elderly or the disabled. This is a non-refundable credit available to taxpayers 65 and older whose income falls below certain thresholds. For a single filer, the AGI limit is $17,500. For married filing jointly, where both spouses are 65 or older, it is $25,000. The credit itself is modest, usually between $375 and $750. But here is the thing. This credit can be claimed in addition to either the standard deduction or itemized deductions. It is not an either-or. The IRS does not promote this credit. The instructions for Schedule R, which is the form you file to claim it, are written in dense bureaucratic language. Most tax preparers skip it because the dollar amount is small and the calculation is annoying. But if you are living on $1,840 a month in Social Security, a $500 tax credit is not small. That is almost a third of a monthly check. That money matters. You also need to understand how the provisional income calculation works for Social Security taxation. This is the mechanism that determines whether your Social Security benefits are taxed at 0%, 50%, or 85%. Your provisional income is your adjusted gross income, plus non-taxable interest, plus half of your Social Security benefits. If that number exceeds $25,000 for a single filer, or $32,000 for married filing jointly, a portion of your Social Security becomes taxable. Those thresholds have not been adjusted for inflation since 1993. Think about that. The government has updated almost every other threshold in the tax code for inflation. But the Social Security taxation thresholds have stayed frozen for over 30 years. Every year, more elderly individuals cross those lines simply because of cost of living adjustments to their own benefits. The 2.5% COLA for 2026 pushed the average benefit to approximately $1,976 per month. That COLA was supposed to help you keep up with inflation. Instead, for many elderly individuals, it pushed them into a bracket where more of their Social Security is taxable. The benefit goes up by $49 a month, but the tax consequence on the newly taxable portion can consume most of that gain. You now know something that most people your age do not know. The system that is supposed to protect your retirement income has a built-in mechanism that quietly reduces a portion of every increase you receive. And the deduction strategy you choose on your tax return is one of the very few tools you have to respond. Here is exactly what I need you to do. I'm going to give you specific steps, not vague advice. Step 1. Obtain your 2025 real estate tax statement. If you do not have it, contact your county tax assessor's office or visit your county's website. You need the exact dollar amount you paid in real estate taxes during the 2025 calendar year. Write that number down. Step 2. Pull your records for state income taxes paid in 2025. If you live in a state with no income tax, like Florida or Texas, your SALT deduction is limited to real estate taxes alone. If you live in a state with income tax, add the state income tax withheld or paid to your real estate tax number. The combined total is capped at $10,000 under the current SALT limit. Step 3. Gather your medical expense records, every out-of-pocket cost that Medicare did not cover. Dental work, hearing aids, eyeglasses, prescription drug copays, mileage to medical appointments at 67 cents per mile for 2025, Medicare Part B premiums of $185 per month, Part D premiums, supplemental insurance premiums. Add every dollar. Then, subtract 7.5% of your adjusted gross income. The amount above that threshold is your deductible medical expense. Step 4. Add your home loan interest or home equity loan interest from your 1098 form. If you own your home free and clear, skip this. If you have any loans secured by your home, obtain that number. Step 5. Add your charitable contributions. Cash donations to qualified organizations, donated goods at fair market value. If you gave more than $250 to any single organization, you need a written acknowledgement from them. Step 6. Add all of these numbers together. Compare the total to your standard deduction. If you are 65 or older and single, compare to $16,550. If you are 65 or older and married, filing jointly with both spouses over 65, compare to $32,300. If your itemized total is higher, you should file Schedule A. If it is lower, take the standard deduction. This comparison takes 20 minutes. It could save you anywhere from a few hundred to several thousand. Do it every year because your numbers change every year. Step 7. If you are close to the threshold, consider timing strategies. If you are planning a charitable donation, make it before December 31st of the tax year in question. If you have elective medical procedures, consider whether scheduling them in a year where your other deductions are already high might push you over the itemization threshold. This is legal. This is smart. This is what wealthy taxpayers do with their accountants every November. You deserve the same strategy. Now, about filing. If you are filing your 2025 return right now, the deadline is April 15th, 2026. If you need more time, file Form 4868 for an automatic 6-month extension, which moves your deadline to October 15th, 2026. But understand this clearly. An extension to file is not an extension to pay. If you owe money and do not pay by April 15th, you will owe interest and possibly penalties even if you filed the extension. If you are owed a refund, there is no penalty for filing late, but you should still file as soon as possible. If you need assistance and cannot afford a paid preparer, the IRS sponsors the VITA program, Volunteer Income Tax Assistance for taxpayers who earn under $64,000. There is also the TCE program, Tax Counseling for the Elderly, which is specifically for taxpayers 60 and older. You can find a location by calling 800-969-887 or by using the VITA Locator tool on irs.gov. Be aware that wait times to obtain an appointment are longer than usual this year because of staffing reductions at the IRS. Contact early. Do not wait until the first week of April. If you believe you made an error on a prior year's return and should have itemized instead of taking the standard deduction, you can file an amended return using Form 1040-X. You have 3 years from the original filing date to amend, and that means if you filed your 2022 return in April 2023, you have until April 2026 to amend it. That deadline is approaching fast. If you filed your 2023 return in April 2024, you have until April 2027. Review your old returns. If you are paying high real estate taxes and taking the standard deduction, You may have left money on the table that you can still recover. For those of you dealing with Social Security and trying to minimize how much of your benefit is taxable, consider whether a qualified charitable distribution from your IRA might help. If you are 70 and a half or older, you can direct up to $15,000 per year from your IRA directly to a qualified charity. That distribution satisfies your required minimum distribution, but does not count as taxable income. It does not increase your provisional income. It does not push more of your Social Security into the taxable range. This is one of the most powerful tools available to elderly individuals, and it is described in IRS publication 590-B. Ask your IRA custodian about it. They are required to facilitate it if you request it. I want to be transparent with you about who I am and what I am doing here. I am not a lawyer. I am not a licensed financial advisor. I am a retired federal employee who spent nearly 3 decades observing the tax system from the inside. I saw good people overpay because the system made it difficult to do otherwise. I saw rules get buried in publications that nobody reads. I saw simplification projects get defunded year after year. When I retired, I made a decision. I was going to spend my time making sure that the people who built this country with their labor, people who drove buses and taught school and welded pipe and raised children, got the same quality of tax information that a partner at a law firm gets from his accountant. That is what I am doing here. Everything I have told you today is based on current law, current IRS publications, and current filing rules. Verify it yourself. I encourage that. Visit irs.gov, read Publication 501, read the Schedule A instructions. The information is there. I am just telling you where to look. Now, let me bring this back to where we started. I told you at the beginning that under 9% of Americans over 65 file Schedule A. That means more than 90% are making a decision worth potentially thousands of dollars based on a default setting, not a calculation. You are no longer in that 90%. You now know the 6 numbers you need to verify. You know how to compare them. You know about the medical expense threshold, the SALT cap, the credit for the elderly, the qualified charitable distribution, and the provisional income challenge on Social Security. You know about Form 1040X for amending prior returns. You know about VITA and TCE for free assistance. That puts you ahead of almost every person your age in this country. If you want all of this in one place, written in plain language, with worksheets you can fill out at your kitchen table, I put together a guide called the USA Daily Alert Guide. 7 IRS rules quietly reducing your retirement in 2026 and how to respond. It covers the itemization comparison in detail, the Social Security taxation challenge, and how to calculate your provisional income, the qualified charitable distribution strategy, the credit for the elderly eligibility worksheet, the amended return process with line-by-line instructions, and the upcoming TCJA sunset provisions that will change your tax situation in 2027 if Congress does not act. It is $27, and it is available at the link in the description below this video. You spent the last 20 minutes learning something that could protect your money for years to come. The IRS will not contact you to tell you that you overpaid. Your bank will not flag it. The government does not send refunds for mistakes you do not catch. The only person who will protect your retirement income is you, and now you know how. I am James Collins. I spent 28 years inside the system. I am telling you what I would tell my own sister, my own brother, and my own neighbors. Verify your numbers. Submit the right form. Do not leave your money on the table. You earned it. Every single dollar of.